Hello and welcome to this deep dive on a powerful dividend income strategy for 2025 and beyond. Today we're breaking down how you can rely on just 3 ETFs to build a lifetime of dividend income with simplicity, robustness, and long-term sustainability. Why only 3 ETFs? That's the first big question. Many investors believe that to generate meaningful income, you need dozens of dividend stocks or funds. But that complexity comes with its own costs: time, maintenance, tax headaches, and the risk of overexposure or overlapping positions. A well-chosen 3 ETF strategy can reduce all that, keeping things lean, efficient, and easier to manage. It's not about over-optimization, it's about smart building blocks. And in 2025, this kind of strategy is as relevant, maybe more, than ever. With macro uncertainty, interest rate fluctuations, and market volatility, investors are once again drawn to equity-based income. Bonds may not yield what they once did, and high-yield investments come with their own risk. Dividend-focused equity ETFs offer a compelling path: the potential for income plus growth plus diversification. Here's the model I'm advocating: 3 ETFs, each playing a distinct role in your income portfolio. 1. High income, to maximize your monthly cash flow. 2. Growth, to give your income stream the potential to grow over time. 3. Stability, to anchor the portfolio and reduce volatility risk. In this first part, we'll dig into the high-income ETF, JEPI, the JP Morgan Equity Premium Income ETF. What is JEPI? Why it matters for income investors? JEPI is not a run-of-the-mill dividend ETF. It's actively managed and structured to generate premium-level income through a smart blend of large-cap U.S. equities and equity-linked notes, ELNs. In practice, JEPI sells call options on its underlying stocks, that is, it writes covered calls. This allows the fund to earn extra premium income, which is passed on, in part, to shareholders as very attractive distributions. Because of this option-writing strategy, JEPI tends to offer higher yields than most traditional dividend ETFs, while also potentially dampening volatility. The trade-off: your upside on market rallies may be capped, since you've sold some of the call rights, but for income-focused investors, especially long-term ones, that's often a sacrifice worth making. Let's talk numbers. As of 2025, JEPI's share price is around $56.74 per share. It pays monthly dividends, which is very appealing for someone building a consistent cash flow stream. Its trailing 12-month yield is about 8.32% according to stock analysis. In its own documents, JP Morgan reports a 30-day SEC yield of 8.20%, unsubsidized. The fund has a large AUM, 40 billion plus, showing that it's well accepted by investors. Its expense ratio is 0.35%, which is reasonable given its active strategy. Pros/cons of JEPI for this strategy: advantages: very high income potential. Thanks to the option premiums, the yield is substantially higher than typical equity ETFs. Monthly cash flow: frequent payouts help you realistically live, or partially live, off dividend income. Lower volatility versus pure equity. The covered call structure smooths some of the downside because premiums buffer declines. Large diversified portfolio. JEPI invests in many large-cap U.S. stocks, giving you broad exposure. Risks, trade-offs, cap on upside. By writing covered calls, JEPI sacrifices some of the potential capital appreciation when markets rally. Complex tax treatment. Because of the ELNs and option premium, the tax reporting might be more complicated than a plain dividend ETF. Interest rate by option risk. If volatility changes or option market conditions shift, the income potential could vary. Distribution variability. While monthly, the amount per month can fluctuate based on how the options strategy performs. Why this ETF fits as the high-income leg of the 3 ETF strategy. Income first. JEPI gives you a strong base-level income. For someone prioritizing cash flow, this is the backbone. Dynamics of option premiums. The covered call approach essentially monetizes some of your upside, converting it into income. Stability via active management. Because it's actively managed, the fund managers can adjust holdings and option exposure to manage risk better. Okay, that's a solid foundation. In the next part, we'll move on to the second ETF in this strategy, the growth leg. This is where we aim to boost future income potential, not just capture high yield today. In this second part, we dig into the growth leg of our 3 ETF dividend income strategy. This is where we aim not just to get cash flow today, but to build a rising income stream over time. For that, one of the strongest picks is DGRO, the iShares Core Dividend Growth ETF. DGRO is designed to give you broad exposure to US companies that have a consistent track record of growing their dividends. It's not about super high current yield. Instead, it's about sustainability and future growth. As of late 2025, DGRO has about 398 to 400 holdings. That kind of diversification helps spread risk, while giving you access to companies that are likely to raise their payouts over time. One of the major advantages here is the cost. DGRO has a very low expense ratio, just 0.08%. For a fund that's actively focused on dividend growth, that's pretty lean. The low cost means more of your money stays invested, compounding over time. Let's talk yield and performance. DGRO's 12-month trailing yield, as of 2025, is around 2.03%. That's not massive if you compare it with ultra-high yield funds, but remember, the goal here is growth. These dividends are likely to increase over time because the companies DGRO invests in generally raise their payouts. The 30-day SEC yield is about 2.16%. Looking at its holdings, DGRO is not concentrated in one sector. It holds large, healthy US companies with a history of stable earnings and solid balance sheets. According to its fact sheet, top holdings include big names like ExxonMobil, JP Morgan Chase, Apple, Microsoft, Johnson & Johnson, and Procter & Gamble. These are companies that can afford to pay and grow dividends over time, which is exactly what you want in a growth-oriented dividend ETF. Risk-wise, DGRO is less volatile compared to pure growth or small-cap funds because of its dividend growth tilt. Its 3-year standard deviation, as per iShares data, is about 12.67%. That means while there's equity risk because it's a stock fund, it's not as aggressive as high-growth tech-focused ETFs, and you get the added cushion of dividend-paying companies. Another plus, because these companies raise dividends, you get the benefit of compounding. Over long time horizons, your income stream from DGRO isn't flat, it can grow, which is a key part of building a sustainable rising dividend portfolio. From a tax perspective, it's simpler than more exotic income strategies. These are regular dividends from US equities, so reporting is more straightforward compared to option-writing funds. This makes DGRO a reliable growth leg for long-term dividend investors. Putting DGRO into our 3 ETF model, it sits in the growth bucket. You're not putting 100% into this, just enough that over time, as these companies grow their earnings and dividends, your total dividend income rises. Combined with a high-income fund like JEPI, which we covered previously, and a stability-focused ETF to anchor your portfolio, DGRO gives the compounding power. In real-world terms, you might allocate a moderate portion to DGRO, for example 30 to 40% of your dividend income portfolio. That way, you lean into growth without jeopardizing your cash flow, and you benefit from long-term compounding. So, that's the second leg, DGRO, your engine for dividend growth. In the next part, we'll explore the third ETF in this strategy, the one that brings stability and broad diversification, helping protect your income stream when markets swing. Now, in the third leg of our 3 ETF dividend income strategy, we bring in stability and broad diversification. This piece is critical. It's not just about income or growth, but anchoring your portfolio, especially during volatile markets. For this stability role, a top pick is SCHD, the Schwab US Dividend Equity ETF. Alongside, you could also consider something like LVHD, a low volatility, high dividend ETF, depending on how conservative you want to be. Let me walk you through SCHD first. SCHD is built around high-quality US companies that have a consistent history of paying and growing dividends. On its website or in its fund docs, you'll find that cost is extremely efficient. Its expense ratio is just 0.06%, which is remarkably low for a dividend-focused equity ETF. That minimal drag on returns means more of your capital stays working for you long-term. As for yield, SCHD has a 12-month trailing dividend yield of about 3.80% as of 2025, according to stock analysis. This is solid income without reaching into risky high-yield territory. It's a sweet spot for reliable cash flow, plus potential for capital appreciation. The ETF pays out quarterly. What gives SCHD its stability is not just yield, but the underlying companies, large cap, well-established firms with strong balance sheets and predictable cash flows. According to its fact sheet, its top holdings include blue-chip names that are less likely to cut dividends abruptly. These aren't speculative plays. They're dependable dividend payers. Risk-wise, SCHD is much more defensive compared to growth-only or high-volatility equity funds. Because it focuses on quality dividend-paying companies, it's generally less susceptible to wild swings, especially in down markets. Investors often lean on it as a core dividend equity holding precisely because of that defense plus yield. From a strategic standpoint, including SCHD in your 3 ETF model gives balance. Here's how it fits. Your high-income ETF, like JEPI, drives your cash flow now. Your growth ETF, like DGRO, fuels future income, and SCHD secures your base with reliable dividends and downside protection. You might allocate a reasonable portion, for example 25–40% of your dividend income portfolio, to SCHD to serve as that foundation. Now, if you want to go even more defensive, LVHD is worth a look. LVHD, Franklin US Low Volatility High Dividend ETF, picks US companies based on stable yield, meaning it evaluates not just dividend amount, but also the price volatility and earnings volatility of its holdings. As of late 2025, its 30-day SEC yield is around 3.71%, and the distribution rate at NAV is about 3.42%. The fund also emphasizes defensive sectors like utilities and consumer staples. The low volatility nature of LVHD means it tends to capture less of the downside when markets fall. Franklin's own literature suggests that LVHD has historically had a better down capture ratio compared to its broader universe, helping cushion portfolio losses. That makes it a very smart choice if your priority is preserving capital while still generating dividend income. Expense ratio for LVHD is 0.27%, per its fact sheet, which is still quite reasonable given the strategy. And because it picks stocks that combine yield and stability, it's not relying on high-yield traps. The methodology filters for companies with sustainable earnings. Putting LVHD into our model works like this. It can replace or complement SCHD in the stability leg. If you're more aggressive or comfortable with moderate market swings, you lean more SCHD. If you want more downside protection, a bigger slice in LVHD makes sense. Either way, this leg helps smooth the ride, especially during uncertain market cycles. Now that we've covered all 3 ETFs separately, it's time to put everything together into a complete long-term dividend income plan. This is where most people mess up, because they either overload on high-yield ETFs or they go all in on growth thinking it'll protect them in the long run. The truth is, a stable lifetime dividend strategy only works when you balance current income, dividend growth, and portfolio stability in the right proportions. That's why combining JEPI, or a similar high-income ETF, DGRO for growth, And SCHD or LVHD for stability gives you a setup that works even if you're investing through unpredictable markets. Think of it like building a house. The high-income ETF is your monthly paycheck. The dividend growth ETF is your long-term promotion. And the stability ETF is the concrete foundation that keeps everything upright during storms. Each has its role, and your job is not to guess the market, but to maintain a structure that holds through every phase. Inflation years, recession years, bull markets, and sideways markets. Let's talk allocation. You don't need to copy anyone blindly. The whole point of a 3 ETF strategy is flexibility. But for most people building lifetime dividend income, a realistic approach looks something like this. A strong income base of around 35–40% in the high-income ETF, about 30–35% in the dividend growth ETF, and the remaining 25–35% in the stability ETF. That mix gives you dependable cash flow now, growing cash flow later, and a cushion that stops your portfolio from collapsing whenever markets go through ugly cycles. What really drives this entire strategy is consistency, not one-time decisions. So the next piece is understanding how to actually run this system year after year. If you're contributing monthly, you don't need to overthink it. Put your new money into whichever leg is underweight at that time. If your high-income ETF has grown too fast and suddenly becomes more than 40% of your portfolio, direct your new contributions toward DGRO or SCHD until the balance resets. This method is simple, but it keeps you disciplined without needing complicated spreadsheets or timing the market. Rebalancing is another part of maintaining long-term dividend income. You don't need to do it quarterly like a hedge fund. Doing it once or twice a year is enough. The idea isn't to chase performance, it's to protect your dividend machine. If one ETF shoots up and another trails behind, you adjust so that you don't end up too aggressive or too defensive without realizing it. Rebalancing also forces you to do something that is emotionally hard but mathematically proven. Buy more of what's undervalued and trim what's overheated. Another key factor in building lifetime income is understanding how dividends fit into your long-term cash flow. People often look at yield alone and think higher is better, but that's how investors get trapped in unstable funds. The reason this 3 ETF model works is because each ETF brings something the others don't. Your high-income ETF gives you cash flow even when markets are flat. Your dividend growth ETF raises your income every year, helping you beat inflation without having to speculate. And your stability ETF protects your capital while still delivering respectable dividends. When the 3 work together, your portfolio behaves like a balanced ecosystem. Growth, income, and stability reinforce one another instead of competing. As you continue with this strategy, something important happens over time. Your yield on cost grows. The dividends you receive in year 10 or year 15 are dramatically higher than what you received in year 1, even if you never chase high-yield risks. That's the benefit of staying invested in companies that raise their dividends and maintaining a portfolio that doesn't blow up every time the market panics. People underestimate how powerful this can be. The income growth snowballs in a way that feels slow at first.